So this is an article written by Lyn Alden, and I am trying out this Speechify, see how it does.
March 18th, 2022, 3:58 a.m. March 2022 newsletter, Global Bifurcation https://www.lynalden.com/March 2022 newsletter/1/March 31st, 2022 newsletter, Global Bifurcation March 17th, 2022 latest article, start here free news. Global supply chains, efficiency versus resiliency. Starting in the early 1980s, China began to open its economy to the rest of the world. And then starting in the early 1990s, the Soviet Union collapsed and its various former states also began to open their economies to the world. This combination brought a massive amount of untapped labor into global markets within a rather short period of time, which allowed corporations to geographically arbitrage their operations, aka offshore a big chunk of their labor force and various facilities, to take advantage of this. This was disadvantageous to laborers and tradespeople in developed markets, and advantageous to executives and shareholders, particularly in the US where we shifted towards massive trade balances in the 1990s. But it did also help hundreds of millions of people rise out of abject poverty in these developing countries, and created hundreds of millions of new global consumers for those global brands as their wealth grew. China experienced a massive increase in the average standing of living, and so did many former Soviet states. Overall, the global price of labor got cheaper. And all else being equal, this was disinflationary for global markets. The supply of labor became quite abundant, which suppressed wages in developed markets. In addition, robotics began to take off, and this was able to displace some types of labor as well. March 18th, 2022, 3:58 a.m. March 2022 news. All sorts of management approaches regarding lean manufacturing and just-in-time delivery became popular among corporations and MBA programs during this era. Some of these had their roots in the early 20th century manufacturing revolution via Ford, Toyota, and others, but they were basically rediscovered, expounded upon, and brought to a new level in the 1980s, 1990s, and 2000s across the entire manufacturing sector. Of course, this was somewhat of an illusion. Companies basically traded away resilience in favor of efficiency, while pretending that there was minimal downside, and yet this type of approach only works under a benign global environment. Outside of the Middle East and a few localized regions around the world, the 1980s through the 2010s was generally a period of limited war as far as supply chains were concerned, with significant global openness and cooperation. Extremely efficient and highly complex supply chains, with limited redundancy or inventory, could thrive in this stars-aligned macro environment. Any company not playing that game would be less efficient in this environment, and thus would be outcompeted. In recent years, many people spoke about how inflation was dead, and how commodity scarcity was a thing of the past. The problem with an efficient but not resilient global supply chain is that it stops working once the smallest of exceptions occur. It could be a natural disaster of some sort, such as a virus. It could be a human disaster of some sort, such as a war. Or both, in the case of the 2020s decade thus far. A highly levered and fragile system is not designed for such shocks. And the problem with calling commodity scarcity a thing of the past is that cheap commodity prices deter new investment in new commodity projects, resulting in stagnant supply and eventually scarcity and higher prices. The commodity industry is notoriously boom and bust in nature every couple of decades due to this dynamic. The Russian impact on commodities. The global economy, in a blank sheet of paper naive design that disregards the complicating factors of geopolitics, basically says this: we'll take Chinese labor and logistics infrastructure, Russian and Brazilian commodities, and developed market institutions and capital, and combine them, and resources from similar countries across the spectrum, into full products and services across the world. Under this operating framework, we don't need to build secondary manufacturing and shipping facilities, because we assume the ones we have in China will always be available. We don't need to build secondary nickel mines for our EV batteries, because we assume the ones in Russia will be open and able to supply the world. Chile can supply our copper, Brazil can supply our soybeans, Russia and Ukraine can supply our wheat, Taiwan can supply our semiconductors, China can supply our labor, and there's no issue here. All good, right? For decades, yes, until it's not. Russia is one of the biggest oil and gas exporters in the world. They're also one of the biggest exporters of wheat, nickel, fertilizer, platinum group metals, enriched uranium, coal, aluminum, and more. It's challenging for the global economy to function without those mines, in the event of sanctions. And in most cases, it takes several years to discover and build a new mine, in what is an otherwise tightly balanced global supply/demand system. 18th, 2022, 3:58. Going forward, any backtests about inflation or disinflation that only go back 20 or 30 years are practically useless. This whole 1980s through 2010s disinflationary period, with one substantial cyclical inflationary burst in the 2000s, was during a backdrop of structurally falling interest rates and increasing globalization, with the sacrifice of resiliency for more efficiency. The world is now looking at the need to duplicate many parts of the supply chain, find and develop potentially redundant sources of commodities. Hold. March 18, 2020. Higher inventories of everything, and in general boost resilience at the cost of efficiency. Macro implications, 2020s versus 1940s. I've been making a macroeconomic comparison between the 2020s and the 1940s for nearly 2 years now, and the similarities unfortunately continue to stack up. For the most part, I was referring to monetary and fiscal policy and the long-term debt cycle for that comparison, with charts like this that my readers are quite familiar with by now. March 18, 2022, 3:58 a.m. March 2022 newsletter, Global Bifurcation. I was also referring to social, generational, and institutional cycles, but less so to geopolitics or kinetic warfare. In other words, the 2020s were beginning to exhibit behavior normally associated with wartime finance, but without a war. Instead, it was a massive global fiscal response to a pandemic-related disruption of a highly levered global economy.
So she's making a reference. I think the 1940s is the Great Depression, but they had a banking crisis before, and they were on their way to the Great Depression. I think the World War got them out of it. But this is saying that we just had our banking crisis, and we're kind of doing this this weird kind of spike up, and then it's saying that the federal debt is going to spike, which I could see happening, and the market's going to crash. We could probably do the same repeat that China did. Like, if you've taken a look at the CQQQ, which is the Chinese tech stocks, I say they're leading and we're lagging. I think we're going to see what they saw. So I think that's really interesting that she points out this, because I could totally see the market going back to like a coronavirus nuke low. And this is over a couple of years, but I'm thinking this could happen within the next 5 years. It could happen this year, because like I don't know, like I could, with all the volatility, I honestly think it's more likely to happen. I think this kind of pump right here is has yet to happen. I think that's going to come at the end of the year. But yeah, I expect with the volatility that we're going to sink a little bit. I think maybe we're on our way to do this, and then yeah, we're on our way to do this, and then Q4 of this year we'll do a pump, and then it looks like at least for a couple years. I know the euro dollar curve is predicting 2024 December, so we're going to keep an eye out for it. But it doesn't look good, and the 2 and 10 yield, treasury yield is almost inverting. So it's something like we really got to be careful and be aware about. This chart is just stuff about the policy with the Fed rate.
I was also referring to social, generational, and institutional cycles, but less so to geopolitics or kinetic warfare. In other words, the 2020s were beginning to exhibit behavior normally associated with wartime finance, but without a war. Instead, it was a massive global fiscal response to a pandemic-related disruption of a highly levered global economy. Well, now we can unfortunately throw kinetic war into the mix as well, and then a secondary financial/geopolitical war happening in the background, with frozen sovereign reserves, global sanctions, shifting geopolitical alliances, and so forth. The world, in many ways, is becoming bifurcated or multipolar. Thousands of Ukrainians are estimated to have been killed or injured in this conflict so far. Even if the war ends soon, it will likely have shifted geopolitics for a very long time to come, and in some ways that we may not foresee yet. At one end, the US and Europe appear more aligned than they have been in a while. At the other end, China and Russia have been pushed close together, and a number of countries have had to take a neutral stance on Russia's war with Ukraine due to their economic reliance on Russia.
Yeah, like I thought it was really interesting. So I looked at the top 10 countries that have, or the top 5 countries that have the most resources. And I think it goes China, India, and then maybe Russia. I've made it's from Investopedia, and like everything, it's basically East versus West. So like most of the countries in the East, uh, they're kind of like the ones that are even neutral, like India, uh, and Russia. They just need to kind of get Ukraine. I think they kind of have like the most resource rich area, and I think if they were to change the world order, those would be the dominant force, and that's kind of why I think CQQ is a good opportunity. If you were to invest on the quarterly close this coming the end of this month of March, yeah, I think it would be a good investment. CQQ, obviously not financial advice. I just think, as far as me, if I was speaking to myself, that's what I would do. If we were having a change in world order towards the east, and them having more of the world reserve or just building towards that, I think this war is the start of that, and then the alliances, and who's like really taking sides, and then the sanctions really taking place, and trade restricting, and then eventually, the we'll just be too overweight that we kind of end up killing ourselves because of too much weight, too much overweight on debt.
H. The world, in many ways, is becoming bifurcated or multipolar. Thousands of Ukrainians are estimated to have been killed or injured in this conflict so far. Even if the war ends soon, it will likely have shifted geopolitics for a very long. India, for example, has avoided outright condemning Russia, in part because it is a huge trade partner with Russia, albeit not for oil, and has had a multi-year plan to increase trade with them. India is a big importer of arms and commodities, which are the two export industries that Russia happens to focus on. Similarly, China gets a considerable amount of energy and commodities from Russia. South American countries in general have taken a harsher stance on Russia than China or India have, but many of them are reliant on Russia for fertilizer, and have taken steps to avoid fertilizers from being included in sanctioned products. Egypt has likewise taken a middling stance. Saudi Arabia and the United Arab Emirates have also drifted away from the US in terms of relations in recent years, with that
Saudi Arabia is the other one in that list. I think it goes China, Saudi Arabia, and then Russia, and then India, or maybe it's India then Russia. But like, I see Saudi Arabia showing favoritism towards the east. So this is kind of just where it's kind of weird, because I mean, the way the oil became into the involved and aligned with the dollars, the petrodollar, is because they had these first, the British was controlling the routes, and then now, after that, and how it evolved, these kings basically controlled the oil, and then the U.S. made a deal with the kings that, hey, we'll protect you, and in exchange for protecting you, you gotta do this, So they decided to buy treasury bonds, and with the extra money they got from selling the oil, and it helped with the dollar. It was basically as good as oil, or as good as gold, the petrodollar. Now that part of the dollar milkshake theory is that these markets help create demand for the dollar, whether it's like debt being financed in the dollar. The debt will create demand for the dollar because they need to have dollars to pay down the debt. If the debt's in dollars, other markets would be like the soybean market. So in order to buy soybeans, they would need to buy dollars. So that would create demand for the dollar by if they wanted to buy soybeans. From Australia, in order to buy copper from Australia, it had to be in dollars. So if they wanted copper, they gotta go get some dollars. So it just created this demand for the dollar. It was like the dollar was its own commodity, and it was becoming scarce because of all the demand for it. And then Saudi Arabia, not only did they buy treasury bonds, but they also required people to use the dollar to buy the oil. Now, that is no longer the case. China is now able to use the yuan instead of the dollar to buy from Saudi Arabia, which is big. It's a big deal. You know, not only will you take away part of the supply sanction from Russia, but now the demand for the dollar is even less because even Saudi Arabia, it's like a double negative. Like even Saudi Arabia is now no longer less enforcing the requirement of buying oil in the dollar. Of course, they can do whatever they want. I'm just pointing out just how demand is declining, and then there is more demand shifting, more value is shifting towards the east. That's the main point I'm making, and then the idealistic point is that maybe demand will and growth will happen in the east, and the east will be like a kind of a world reserve.
Trend continuing during this current conflict. The Wall Street Journal ran a piece called, "If Russian Currency Reserves Aren't Really Money, the World is in for a Shock." The gist of the piece is that if sovereign reserves are easily freezable, this may spur central banks to reevaluate their reserve practices and shift more towards gold as a reserve asset once again, while also focusing on maintaining larger raw industrial/agricultural commodity inventories. Scarce commodities, physically held within the country's jurisdiction, can't be sanctioned or frozen. Similarly, Credit Suisse published a piece by former Federal Reserve analyst Zoltan Shar, called Bretton Woods 3 with this rather strong introduction. We are witnessing the birth of Bretton Woods 3, a new world monetary order centered around commodity-based currencies in the East that will likely weaken the euro-dollar system and also contribute to inflationary forces in the West. Crisis is unfolding. A crisis of commodities. Commodities are collateral, and collateral is money, and this crisis is about the rising allure of outside money over inside money. Bretton Woods 2 was built on inside money, and its foundations crumbled a week ago when the G7 seized Russia's FX reserves. March 18, 2022, 3:58 a.m. March 2022 Newsletter, Global Bifurcation. https://www.lynalden.com/March 2022 The structured global monetary system tends to change every several decades either due to new technology or sovereign defaults, often both, and yet participants tend to assume it will be permanent this time, which is a classic end-of-history perspective. The system changed significantly in the 1920s through the 1940s after the World Wars and Great Depression depleted many countries' ability to maintain their currency gold pegs, including on the winning side of the wars. It changed significantly again in the 1970s, when the U.S. defaulted on its currency gold peg and established the petrodollar system with Saudi Arabia in its aftermath. My latest article on the nature of money itself went into some of these major shifts. The 2020s could very well mark the next change, with a shift toward sovereign reserve diversification and an emphasis on neutral reserve assets once again, in light of a less cooperative global environment and the ability and willingness.
So this is big. This 2020s. So one of the big points that she was making is that the market today was built for efficiency, not resiliency. And because now there's a need for resiliency, the efficiency is just falling apart and it's fragile. So that was the main part from the beginning. And then she made a comparison of the 2020s and the 1940s and just the similarities of monetary policy. And then she went into Ukraine and the war and how it's making some kind of wave pools and energy and the prices and the stability. And then now she's saying that 2020s could be the next change towards sovereign reserve diversification. So that's kind of just been already happening. But neutral reserve assets, which is around like commodities. And what sucks is that the U.S. doesn't have a whole lot of commodities. They used to produce a lot, but now it's become so specialized, especially in the U.S. of just delegation, that either labor or just certain goods are not produced here. So now that's kind of some either security issue, or it's just a fragility risk issue. So it's going to be really interesting, and I think this is kind of what the the people who talk about the Great Reset are talking about. I think it's the whole neutral reserve asset. It's going to be, surrounding commodities at first, but then we'll kind of see who rises at the out of that at the top. I think uh, I don't know, like Germany, they've kind of exploded in debt like a couple times. Like I think during like the Roaring Twenties, but I think during through those hard times that some Rush like Hitler came from those times. He came out of the spur, out of the debt of the, I think it was like the crash of the 30s. I don't know. I forget. I know we had the Roaring Twenties, and then we had the crash in the 30s, and I think Adolf, like if the war was around the 40s, then let me see. It sounds about right. Like maybe some kind of negative figure will come out of it. So 1930s. So yeah, like when the Roaring Twenties got bad, when austerity hit the world, really bad leaders came out of that time. So maybe the same is of this future. I mean, we already have one right now, so we'll see what's going on.
To freeze each other's sovereign reserves if those reserves are held in fiat liabilities. Meanwhile, the Fed's no-win scenario. With official inflation levels at nearly 7.9% year over year, the U.S. Federal Reserve is basically forced to try to tighten monetary policy. Their short-term interest rate is the furthest below CPI since 1951. March 18, 2022, 3:58 a.m. March 2022 newsletter, Global Bifurcation. Just yesterday, the Fed increased their rate by 0.25%, which marks the first rate increase since 2018. This unusually wide gap between inflation and interest rates is one of the key reasons I regularly compare the 2020s to the 1940s, rather than primarily the 1970s, despite some other similarities there, and I have been making that comparison for nearly 2 years before the gap became as wide as it is now. My May 2021 newsletter went into detail on this dynamic, but basically, since debt was so high in the 1940s, unlike the 1970s where it was low, and the inflation was driven by fiscal spending and commodity shortages in the 1940s, rather than a demographics boom and commodity shortages as in the 1970s, the Fed held interest rates low even as inflation ran hot in the 1940s, unlike the 1970s where they raised rates to double-digit levels. March 18, 2022, 3:58 a.m. March 2020. St. Louis Fed. Unfortunately for the Fed, the U.S. economic growth rate is already decelerating, and basically the only way to reduce supply-driven inflation with monetary policy is to reduce demand for goods, which is recessionary. The ISM Purchasing Managers Index, for example, has been pointing downward, and so have the weekly leading indicators. Chart source, Trading Economics. Credit markets are already weakening, the Treasury market is becoming rather volatile and illiquid, and the Fed has ended quantitative easing. The Fed is likely to continue monetary tightening until financial markets get truly messy, at which point they may reverse course to the dovish side yet again. Stagflationary economic conditions are inherent.
So that's kind of like the prediction, the dovishness coming out, and with the forecasting software, it's looking like near the last quarter of this year, around I don't know, like August, September, October, around there. It's looking more dovish, especially with the election passing and things more settling in, and just less like uncertainty, more certainty. Like it's probably like it'll look more dovish, and probably a lot of austerity, and probably it could be just hardship, where the government just needs to spend and stimulate the economy. That's I think it would likely either I think it will happen later this year. Like I'm kind of thinking those six rate hikes. I don't know what the dates they're supposed to happen on, but from what I've heard, they height rate whatever they they increase the rates enough. Like if you look at Macro Voice's podcast, they do it until it breaks. So I expect them to turn dovish, do the Powell pivot again, and I'm expecting it to go in line with the forecast model or whatever.
Apparently hard for central banks to deal with, stagflation is somewhat outside of their expected models. In fact, the Fed might end up being forced to tighten liquidity with one hand and loosen liquidity with the other hand, using various standing repo facilities, SLR exemptions, purchasing off the run securities, and similar options available to them to maintain sufficient liquidity, while officially doing no more broad quantitative easing for a while. March 18, 2022, 3:58. This is another reason why countries may shift towards gold and other commodities for a portion of their official reserves. Not only can fiat reserves, bonds, and deposits be frozen by foreign countries that issue those liabilities, they also keep getting devalued with interest rates that are far below the prevailing inflation rate because debt levels are too high to raise rates above the inflation level. Official sovereign reserves represent decades of accumulated trade surpluses for a nation. The last thing they should want to do is hold the entirety of those reserves in melting ice cubes that diminish the purchasing power of their national savings. This continues to be a very uncertain time for most risk assets.
So that's really interesting. I wonder if, she's talking about bonds, and I wonder if she's talking about the U. I mean, technically, whenever the U.S. prints, like everybody else prints, so like it makes sense. No one wants to hold on to treasury bonds anymore. Like it's just melting ice cubes, especially with the inflation, and it's just melting and melting with the purchasing power of their national savings. It just doesn't make sense anymore.
Assets, and I continue to have a rather defensive stance while still seeking out attractive equities where possible, including many in the healthcare sector, consumer staples sector, and energy pipeline industry. I also like to be overweight commodity producers in this environment, even though they will have periods of cyclical downside moves. For alternative assets, I view gold and Bitcoin as attractive monies to own as part of a portfolio. In a world where fiat money supply is expanding at a double-digit rate and interest rates are well below the prevailing rate of broad price inflation. Portfolio updates. I have several investment accounts.
So here's where I think she like starts to plug in some stuff where she can make some money. But yeah, like she's got it spread out pretty good. I mean, it looks like an ETF. Like it's so spread out. I mean, even her portfolio has ETFs in it. Like there's ETFs there, and then she's got like different dividend stocks. She's got so many stocks that it kind of looks like an ETF. But changes since the previous issue. Um, but yeah, that's pretty much it. That's pretty much it. And then she kind of talks about Bitcoin a little bit. But yeah, I think that's it. And thanks for listening. I guess to sum up the points would be like she's kind of stating the obvious, like, hey, our economy was optimized for efficiency, but it was fragile, and now it's no longer efficient, and now we want something. We kind of need a market that's more resilient. So that was like a really interesting point. And then she's also pointing out that our fiscal policy is similar to the 40s, and then she was pointing out just kind of I guess the debt, and the debt is similar to the 40s, so she was like alarmed. And then she was also pointing out the war, and just kind of uh, the context and what's going on with that. And she's like bullish on energy, it looks like. And it doesn't. She's basically saying it doesn't look like it's good for fiat, and especially the ones that have lots of debt, because usually whenever they have hold lots of debt, they have to, in times of war or emergency, they need to print more, and then on top of the current debt and also the current needs, or the needs expand, especially like for instance energy. So she thinks like those that have a lot of debt will start to go down a slippery slope faster. I mean, it's the melting ice cubes, so people would want to dump those the natural what's it called, sovereign sovereign savings that she said. But that's pretty much it. Take what you want from it. I like Lyn Alden. She's like a macroeconomist. I'm trying to make a play on oil as is. I'm waiting for like 322, and then we're gonna see where we're at. And then as far as like S&P 500. We're still following our dates, and it's looking like it's going to be really interesting this year with the election and just the quarterly close of this month. It already is interesting for China, and I'm kind of thinking they're ahead of the curve. They're either ahead of the curve by like 6 months from the U.S. or maybe 3 to 4, or they're just, I don't know. I almost think they're ahead of the curve, and we're lagging, and they're leading, and that's kind of just forecasting what's to expect. The I don't know. The China's been kind of going down for the past 3 days, and we've been going up. So once we go down, maybe they'll be going up. So I guess it would be that kind of relationship. But we'll see. We'll see what happens. It makes sense that once the U.S. dollar prints, maybe they're doing inverse tightening and printing. That's kind of just the only thing I can think of. But thanks for listening. I'll see you in the next video.